Okay, let's kick off this explainer by picturing two completely different types of investors. Imagine two people starting out with the exact same amount of money. The one on the left, well, they're constantly researching, trying to perfectly time the dips, stressing over market predictions, basically driving themselves crazy. But the one on the right, they just buy the most boring fund in existence, set up an automatic transfer, and literally forget the app is even on their phone. Fast forward 30 years later, and that boring investor retires a millionaire, while the quote-unquote smart one ends up with less than half that amount. Today, we're diving into the data that proves why doing absolutely nothing might just be your ultimate financial superpower.
Welcome to the Explainer. Today, we're breaking down a playbook that's going to reframe your entire relationship with money. Seriously, this isn't just about what stocks to buy. It's about figuring out how to get out of your own way in what is arguably the strangest market we've seen in modern history. We're going to build your armor against human panic and set up a system that literally thrives on neglect.
Here is our exact roadmap for today. We're going to cover the 2026 market reality, the cost of doing nothing, building your financial armor, filling your wealth buckets, the boring portfolio, and finally, how to automate and ignore. Let's jump right in. All right, Section 1, the 2026 market reality. The playing field? To start things off, we really have to be brutally honest about the incredibly top-heavy year we're looking at right now. Check out this number, 40.7. That's the Shiller Cape ratio. Basically, it compares stock prices to actual company profits. Now, the long-term historical average is around 17, but right now, we're sitting at 40.7. That means we are looking at the second most expensive market valuation in 140 years of recorded history, only surpassed by December 1999. Add in the fact that just 7 giant tech companies make up roughly a third of the entire S&P 500, and it makes total sense why experts are forecasting lower than average returns over the next decade. So looking at those crazy expensive valuations, your human instinct might just be to wait for a crash. But you know what? That completely reasonable instinct is actually the single most expensive mistake you can make in investing. Think back to 2012 when everyone said the market was overvalued. Well, the people who stayed on the sidelines waiting for a crash missed out on a massive 13-year run-up. The market absolutely punishes impatience and rewards stubbornness. So our strategy? We don't wait, we stop gambling, and we start planning. Moving on to Section 2, the cost of doing nothing. The behavior gap. Let's look at how these weird market conditions trigger psychological traps that absolutely destroy wealth. This Dalbar study data illustrates something crucial, a massive behavior gap. Look at this difference. In 2024, the market practically handed out a 25% return, but the average equity investor, they only took home 16.5%. That's an 8.5% gap. And here's the kicker. That money didn't evaporate because of high fees or some market fraud. It vanished because people fumbled a third of their returns onto the floor by panicking, pulling their money out, and then trying to perfectly guess when to get back in. And this JP Morgan study really hits the nail on the head as to why jumping in and out is just a terrible idea. If you just bought, held on tight, and enjoyed the roller coaster, 10 grand turned into almost $65,000 over 20 years. But if you tried to time it and missed just the 10 best single days over that entire 2-decade stretch, your returns were slashed by more than half. And here is the cruel joke of it all. Statistically, 7 of the 10 best days in the market happen right next door to the 10 worst days. If you panic sell after a brutal week, you're pretty much guaranteeing you'll miss the explosive rebound. Which brings us to Section 3, build your financial armor. Protect your wealth. Since we know we are usually our own worst enemies, we have to build a defense system. Now, before we even think about buying a single stock, you've got to execute these steps. First, kill that high-interest debt. Mathematically speaking, paying off a 24% credit card is identical to finding a guaranteed, totally risk-free 24% return on an investment. Next, get yourself a 1-month starter buffer in cash, and then build a 3 to 6 month emergency fund in a high-yield savings account. Why? Because this pile of cash is your armor. It's the only thing that ensures you never have to sell your investments at the absolute bottom of a crash just because your water heater exploded. All right, Section 4, fill your wealth buckets. Tax strategy. Once your armor is securely in place, it's time to actually invest. But we don't just randomly pick investments. We pick tax-advantaged containers in a very specific order. This order of operations right here is definitely worth remembering. First, you hit the 401k purely to grab your employer match. Then, you fund the health savings account, or HSA, Seriously, this is quietly the most tax-advantaged account in America. It's triple tax-advantaged and acts like a stealth retirement fund. Next up is the Roth IRA, where your money grows completely tax-free forever. And only after that do you circle back to max out the rest of the 401k and finally dump whatever's left into a regular taxable brokerage account. Now, take a look at this massive number, $43,000. That's the average amount of free money forfeited over a 20-year career by the 1 in 4 workers who just decline their employer's 401k match, usually because the paperwork is confusing. Think about it. If your employer offers a 50% match, that is an instant guaranteed 50% return on your money the exact second it lands in the account. There is literally nothing else like this anywhere in finance. Do not leave this free money on the table. Okay, Section 5, the boring portfolio. Own the haystack. The buckets are built, so let's talk about what actually goes inside them. This data is a real game changer if you're tempted to pick individual stocks. A huge study looked at every single U.S. stock since 1926, and what they found is mind-blowing. The top 4% of companies accounted for literally 100% of all the wealth the stock market has ever created. That means the other 96% of companies out there collectively just match the return of boring government treasury bills. So instead of exhausting yourself hunting for that tiny 4% needle in a massive haystack of losers, you just buy an index fund. You simply buy the entire haystack. And you have to watch out for the fees because they secretly act like a tornado on your wealth. You might think a 1% active management fee sounds tiny, right? Well, over 30 years, compared to an index fund that charges almost nothing, that little 1% fee quietly consumes nearly $187,000. That's a quarter of your final wealth, just gone. Fees are pretty much the only thing in investing that compound against you with absolute certainty. So what do you actually buy? Well, since a handful of U.S. tech companies dominate a third of the market right now, you absolutely need diversification. This classic 3-fund starter portfolio does the trick. Roughly 60% U.S. total market, 30% international total market, so you aren't just betting your life savings on 7 American companies forever, and 10% in bonds to smooth out the ride. Or you can make it even easier and automate the whole shebang by buying one single target date index fund, which balances all of this for you automatically. Finally, Section 6, automate and ignore. Lockdown machine. Let's lock this wealth machine down so it runs completely free of your own emotional interference. I want you to make a mental commitment to this exact phrase right now. Seriously, write it down on a sticky note if you have to. A 30% market drop is not a risk, it's a scheduled event with an unknown date. It is literally the entry fee you are required to pay to get those compounding wealth returns. So when the market inevitably crashes, you change nothing. Your automated transfers just keep buying shares while they're on sale at a massive discount. The only people who get destroyed in crashes are the ones who panic, try to sell, and walk away. I'm going to leave you with this final provocative thought. True greatness and investing isn't about timing the perfect entry point. And it's certainly not about picking the ultimate stock. It's about setting up a profoundly boring system and completely trusting the math while everyone else is out there frantically chasing the hype. The market is basically a giant engine perfectly designed to transfer money from the impatient right into the pockets of the patient. So you have to ask yourself, are you willing to just sit back and outsit everybody who is exhausting themselves trying to outsmart the system? Set it up, forget your password, and just let your money do the work for you.